Okay, so let's move to the last part of the fixed income, the study session 8, reading 20 and 21. So let's cover reading 20 first, which is on the yield curve strategies. So in this chapter, we will understand how can you do active bond management using your skills and your knowledge of the yield curve, and how do you predict how the yield curve will move, and how do you benefit from that yield curve movement. So broadly, we are going to cover four topics. The first one being the yield curve strategies and the carry trades. Second is how can you use convexity, or how can you alter the convexity as per your view of the portfolio. Third will be how do you use the derivatives for your optimal strategies. And the fourth will be intermarket strategies and the expected returns. So the first part, yield curve strategies, the first sub part is the stable yield curve. Now, whenever you have a yield curve in picture, you can always have two types of yield curve. One could be a stable yield curve, which will look like there's upward sloping, and or you could have an unstable yield curve like this. Not a ideal scenario, but it could be. So, what happens if you have a stable yield curve strategy? Okay, so I'll just erase the unstable one first. Okay, so the idea over here is to cover what happens if you have a stable yield curve strategy. Simply buy and hold. Here is the tenor, and here is your yield. Simply buy and hold because you're buying at lower interest rates and selling at higher interest rates. So you will get the entire YTM. If the yield curve is not subject to changes, is not subject to any change, it is more or less going to be stable. So the YTM that you opted while purchasing the bond, say suppose 5%, you'll get something close to 5% only because the yield curve is expected to be stable. So there is less interest rate risk. So just hold on upward sloping yield curve. Aim is to hold the stable yield curve, and since there is no purchase and sale of multiple securities because the yield curve is not changing, your transaction costs are low, hence your low management fee. So buy and hold, just do nothing. Second is riding the yield curve. So once you have an upward sloping yield curve, okay, let's erase all this. We have done this in L2 also, so I'll just cover it briefly here. So once you have an upward sloping yield curve, and say you have a tenor of say 0, 5 year, and then you have a 10 year. Now you're having yields at higher rates over here and lower rates over here. Suppose your investment horizon is only for 2 years. Your investment horizon is only for 2 years. What you can do, you can buy at the steep end of the yield curve and roll over. So what you can do is, here the rates are low, so the price will be high because yield is opposite to price. So low interest rates, the bond will be expensive to buy. But here the interest rates are high. So you buy a 10-year bond. You buy a 10-year bond with a horizon of 2 years. With a horizon of 2 years. So you will buy it over here. Now you know that the yield curve is going to be stable. So at the end of the 2 years, you will be still selling the security. When you'll be selling the security, the yield curve is upward sloping, and it is expected to be stable. So the yields won't move, the prices won't move much, right? So what you can do is you enter over here. You got this security cheap, say suppose 97. The same security over here was for 100 point something, say 100.20. Because if you could have buy over here for 2 years, you would have got it at an expensive price. But now since you have got it at a steeper end of the yield curve, the yield is higher over there, so the price is low. So you buy at 97, and after 2 years, maybe you get something like 99.5 example. So what you have done, essentially you did what you opted out for. You wanted to enter into a 2 year bond, but rather than buying it at the lower end of the yield curve, you bought a 10-year bond and held it for 2 years. In this way, you just rode the yield curve. You just rode the yield curve. But this is only applicable if the yield curve is stable. Otherwise, you are exposed to interest rate risk. Carry trade, similar to yield curve riding, but it's in different interest rate curves. So it is, again, you borrow at a lower yield currency and invest at higher interest rates. So what are these FIs doing in India? They are borrowing in USA at suppose 1% interest rates, and they're investing in India at say suppose 6%. The repo rate is 6%. So they're investing in India at 6% interest rates. You just imagine that if the yield curve remains stable, there is a 5% net gain on the interest. And if the currency also moves in their direction, if the currency also moves in their direction, they will have a pure profit by taking zero risk, absolutely zero risk. So if this yield curve is expected to be stable, you borrow at a lower currency, you borrow in US dollar or US yield curve and invest in high interest rates. Now this could be if I am doing intermarket, but what if you want to do it in within the market? You do the same strategy over here. We use the same strategy over here. We take the 10-year yield curve. So you borrow at around 2 years. You want to borrow for 2 years, so you borrow at this tenor. So you'll get at the lowest interest rate, say suppose 4% for example, and you invest that same money in a 10-year bond. Over here you're getting a price of 97 and I see a yield of 8%. So you borrowed at 4% at the shorter end of the curve. So I'll just depict the borrow from a red color. So you borrow here and you take that money and invest it at the steep end of the yield curve here, and you hold it for 2 years. Since the yield curve is expected to be stable, your 4% borrowing and 8% return will more or less remain same, and you will have a 3% return by taking absolutely no risk. So this is the carry trade. The last one is a bit tricky, so let's understand the concept first. Sell convexity. In a stable yield curve, high convexity will not benefit the bondholder. Hence, one can reduce convexity and earn higher yield. Suppose you have a portfolio of five bonds, okay, and top four bonds are of low convexity, but this bond has got high convexity. Now you know that convexity protects your downside if the rates go up, and gives you better result when the rates go down. It gives you more profit. So convexity is good for your portfolio. But if the yield curve is expected to be stable, if the yield curve is expected to be stable, what is the use of this convexity? What is the use of this bond with a higher convexity? It is not going to give you any benefit, right? Because if the yield curve is stable, then the convexity will be the convexity impact will be very low. And since you know that a higher convexity bond will have a lower yield, you might as well sell this bond and get into a higher yield bond, because your expectation of the yield curve is to be stable. If you have any questions, you can put it in the comment box. Let's move ahead. Now, the first scenario we saw for the stable yield curve. Now we move to the changing yield curve, which is the ideal scenario, and the change could be both parallel and non-parallel. So we'll first see the parallel case. Suppose you have a yield curve over here, and you expect a parallel change in the yield curve. You expected a parallel change in the yield curve. So adjust the portfolio duration. Parallel change yield with same duration, same value. If rates are expected to increase, then decrease the duration, and vice versa. So if the rates are expected to increase, if it's an upward parallel shift, let's also take the downward parallel shift. So if it's an upward parallel shift, if the rates are expected to increase, then decrease the duration and vice versa. It's very simple that way. Let's understand. If the rates are going to increase, what will happen to your price? Your price will fall down. If the rates are expected to increase, then decrease the duration. Then decrease the duration. That means sell the long-term bonds. Sell the long-term bonds, because if the rates are going to increase, the prices will go down, and vice versa. Obviously, if the rates are going to go down, you increase the duration, right? Because now you are going to get better price in future. Obviously, in a yield curve shift, which is parallel and non-parallel, convexity will always be beneficial. We explained in this slide that in a stable yield curve, where the yield curve is not expected to change, the convexity is of no use to you. So you better sell those bonds and enter into high yield bonds. Enter into high yield bonds. But over here, the yield curve is expected to change. That's why you need to keep the bonds with high convexity, so that it will benefit you in case the yield curve is expected to change. So the non-parallel yield curve, the concept here is simply to manage the duration risk and increase or decrease the exposure in those areas of the yield curve where shifts are non-parallel. So let's take an example, very simple. This was a yield curve. Okay. Now we expect that the yield curve might move like this. Okay. So this is the non-parallel shift. Now what's happening? In the longer term tenure, your rates are increasing. And what do we do when the rates are increasing? We decrease the duration. So in the longer term bonds, you will decrease your exposure. And over here, you can see the interest rates are going down in the short term duration. You can see the interest rates are going down. If the interest rates are going down, you expect the prices to go up. So you will increase exposure in short term and decrease the exposure in long term. So this is like a steepening of the yield curve. Okay. So wherever the interest rates are increasing, you have to decrease your exposure because your prices will go down. And where the interest rates are falling down, you have to increase your exposure so that you are less exposed to interest rate risk. There are three types of non-parallel shifts: bullet, barbell, and ladder. So let's see. So in the bullet strategy, all your concentration will be in a closed up tenor. This could be 9.5 year maturity. This could be 10.5. The agenda is that most of your investments will be clubbed in a single tenor. In a barbell strategy, like in your gym, you have a barbell, right, which you use to work out. So in a barbell strategy, you will have some exposure in the short term, you will have some exposure in the long term, and the medium term will have no exposure or very less exposure. But over here, let's consider we have no exposure over here. So in the barbell, we have 50% over here, and we have 50% over here. And say a laddered strategy. A laddered strategy means you have exposure at all points of the yield curve. You have exposure at all points of the yield curve. So you have certain exposure at this 5 year, 6 year, 7 year, 10 year, 12 year, 15 year. Bullet concentrated tenor post portfolio. We saw this. Balanced portfolio in long and short term. Barbell. We saw this. Investment spread across the yield curve or tenor. Laddered security. Just like a ladder. All the above strategies can be used in order to increase or decrease the duration basis the anticipation of the yield curve. This is known as the active bond portfolio management. So we will now see how do you manage these three strategies. So bullet versus barbell. Okay. Over here, let us consider one thing what we were doing over here. In this stable yield curve, you are not exposed to any interest rate risk. That's why you're not adjusting anything. In the unstable yield curve, you are exposed to interest rate risk. That's why you're adjusting your duration. That's why you're adjusting your duration. And what is duration? Duration is termed as the interest rate risk, right? At the macro level, duration is the interest rate risk. So over here, we are now going to study that. We have now already studied that in case the yield curve moves parallelly, then increase the then increase the exposure where the yield curve is falling and decrease the exposure where your interest rates are increasing, right? We'll also see now what happens to the convexity. Now we have adjusted your duration, right? Using these two techniques of selling and buying bond in different tenors, you have managed your duration exposure. Now let's do for the convexity. The first one is bullet versus barbell. So we know bullet is some portfolio which has concentrated portfolio, and barbell is a portfolio which is balanced between long and short term. Now, what happens over here? Yeah. So now we are going to manage the convexity. So bullet versus barbell. To increase the convexity, enter into a barbell strategy. Why? See, whenever you are exposed to a single tenor, if the rate changes here or here, the portfolio convexity is not going to change, right? Only if the rate changes at this exact point is when your portfolio is going to change, your convexity is going to change. So whenever you want to increase your convexity, you need a much more dispersed cash flow, right? Consider this as an example of a yield curve. Suppose you have a yield curve, and this blue denotes a bullet portfolio, and this red denotes a barbell portfolio. Now, obviously, if the interest rate changes, the red points which are exposed to more yield curve points are subject to more changes rather than the blue point. So the convexity will only change in if you have distributed cash flows. So if you want to increase the convexity, get into a barbell strategy. If you want to decrease the convexity, enter into a bullet strategy. Enter into a bullet strategy and concentrate all your exposure to a single tenor. That was to adjust the convexity. Now, if I go back to the topic, we covered this. We covered this. Now we cover derivatives and optimal strategies. How do you use derivatives? Options on bonds. Buying options to increase the convexity and sell the options to decrease. Now, what happens when you buy an option? What do you pay? You pay a premium. So, what is your outflow? Your outflow is your bond cost plus the premium. So, if you are going to pay anything above the price, what is going to happen to your yield? Your yield is going to go down because you are going to pay more price to this thing. So, when your yield goes down, but why is the yield going down? Because you have a protection. Now let's understand when you buy an option, call option on a bond. So a call option on the bond, if the interest rate goes down or up, so you have a call option on the bond which says that if the interest rate goes down or up, you will be protected. You will be protected up till your strike, and for that protection you need to pay a premium. What happens in a convex? What happens when you have higher convexity? The higher convexity protects your downside. The higher convexity protects your downside and gives you an upside. So what is this call option doing? It is giving you an option. It is giving you the same option, a similar option. That's why it acts as a positive convexity. And when you don't give that option and you don't have this option, you lose the option to put the bond, call the bond, or increase your returns by paying the premium. You simply decrease the convexity. Let us consider it again. Buy options to increase the convexity. So we know convex when you have a higher convexity, and if the interest rate falls, the upside is more than a normal straight bond or a normal bond with lower convexity. And if the interest rate goes down, your down sorry, if the interest rate goes up, your downside is protected. It goes by a lower value. And if the interest rate goes down, the upside is from with a higher value if the bond has higher convexity. The same happens when you have a call option on the bond. When you have a call option on the bond, because you are paying a premium, you are paying a premium on the bond. So what will happen is, if the interest rate goes up, if the interest rate goes up, your bond value will go down. But since you already have a call option on the bond, that will help you. Similarly, if the interest rate goes down, your bond value goes up. But if the interest rate goes down a lot, the bond might get called. The bond might get called by the issuer. So it is also providing a similar kind of a protection. So that is why you buy the options to increase the convexity. If you can't remember, just remember this thing, that a bond with higher convexity will have a lower YTM, will have a lower YTM, and a bond which has a call option or a put option will also have a lower YTM, because option premium reduces the portfolio yield, similarly like how convexity does. Higher convexity, lower yield. Options on bond, lower yield. Bonds with embedded options. Callable bonds and MBS have negative convexity. Why? So we discussed over here. Suppose an issuer has issued a bond at 10% in the market, right? Now the interest rate goes to 6%. Example, just a hypothetical. Why will he pay you 10%? He has borrowed at 10% from you. Now the market has come to 6%. Why will he pay interest at 10% to you? He will call this bond. He will call this bond and issue new securities at 6%. Simple. But if you see over here, since the interest when the interest rates were following, the prices were moving up, right? The prices were moving up. The prices could have moved more on the upside had the bond not been called. But since the bond got called, it went against the concept of convexity, because when the interest rate falls, the bond prices rises more. But since there is a call option, the bond prices rises a little less, and the bond gets called. So that is why it is showing a negative convexity. Negative convexity. Callable bonds have negative convexity. Negative. Puttable bonds have higher convexity than a normal straight bond. It's very simple. Suppose you bought a bond at say 8%, right? And suppose you had bought this at 99, at a price of 99. Now the interest rate goes to 10%. Now the interest rate goes to 10%. What will happen to the price? The yield is rising. So what will happen to the price? And suppose the interest rate rise. Now what happens when the interest rate rise? Your bond value goes down. The bond value goes down. Suppose the interest rate goes to 11% now. The bond value will fall more. It will go to 94 now. Example. This is a risk to the bondholder. So the bondholder buys a puttable bond. And when the interest rate rises to 10%, simply he will put his bond and exit the position. He will simply put his bond and exit the position. Now, if you see, the downside was protected. The downside was protected. Why? Because it was a puttable bond. That is why it has a higher convexity than a normal straight bond. Because of the put, the bond got protected. The downside got protected. That is why it was showing higher convexity. So callable bonds and MBS have negative convexity. Now from this we can infer two things. To decrease the convexity, buy the callable or MBS bond. To increase, sell them. Why? When you want to decrease the convexity, you need negative convexity. And you get negative convexity when you have callable and MBS bonds. And to increase the convexity, buy puttable bond and vice versa. It's quite simple in that sense if you consider it, and except just the difference between a stock and a bond is whenever you are doing a bond analysis, you also have to consider the yield and the price together. Only then you will come to know. So when the yield is decreasing, the prices are increasing. So you have to consider both the factors together, and then only you'll be able to get out of this confusion. We then move our attention to carry trade. So we saw the carry trades along the yield curve, wherein you borrow at the lower end and invest at the higher end. So this could be one of the carry trade. The multi-currency carry trade is the similar, wherein only the curves changes. You borrow in USD and invest in INR. But the only thing is that since it's a multi-currency, it is exposed to FX risk. And once this FX risk becomes very volatile, there could be an unwinding risk, right? Suppose the dollar pair, the dollar and the INR pair becomes very volatile. What will happen? Large positions will start unwinding. That will trigger stop losses. That will trigger stop losses, and that will also trigger the positions of the dealers because of the very fast movement of the FX risk. Now we see the derivatives. How do we use the derivatives to manage the duration and convexity? So that way it is open to risk. Now, how do you use the derivatives to manage the duration and convexity? So we have seen already that for convexity, we buy the callable bond and MBS bond, and to increase the convexity, you either buy the puttable bond and vice versa. We have seen this in the previous slide. Now, for the duration, to increase the bond duration, you buy the bond futures, and to decrease the bond duration, you sell the bond futures. And in terms of OTC swaps, to increase the duration, you enter into a receiver swap, and to decrease, you enter into a pair swap. Why? See, a swap has two legs. One is a receiver leg, one is a pair leg, and the receiver leg can be fixed or floating. So let's take a fixed leg, and the paying leg will be floating. Now, a fixed rate will have a duration close to their interest rate, say suppose 8% example, but a floating leg duration will be only up till the next reset. So the next reset will be in say 3 months, and suppose 9 is the annual, suppose 12 is their annual rate of interest. So the next duration will be only up to 3%, right? 12 divided by 4. So let's do it again. A pair swap will pay fixed, pay leg, receive leg. So if you pay fixed, you pay the entire duration of the interest rate, say 8% example. And when you receive fixed, when you pay floating, you pay the duration only up to the next reset, right? This 8% in annualized, this 4% is only up to the next reset. Why? Because on the next reset, the interest rates are going to get rechanged or recalibrated. Now, over here, if you see, the fixed leg will always have a duration which is greater than floating leg, will always have a duration which is greater than floating leg. So, if you enter into a receiver swap means you receive fixed and pay floating. Receive fixed, pay floating. So when you're receiving fixed, you're receiving 8, you're paying floating, you're paying 4. Your duration is increased. And if you want to decrease the duration, you will do the opposite. You will enter as a pair swap where you pay fixed, so you pay 8% and you receive floating, so you receive 4%. So you end up with minus 4%. So you want to decrease the duration, enter into a pair swap, increase the duration, enter into a receiver swap. There is a statement written on KRD in the last section. Key rate duration is change in portfolio value for change in specific points in yield curve, structural risk. So you have a yield curve. If it moves parallelly upward, it's a parallel curve, parallel shift. It moves parallelly downward, it's a parallel downward shift. Where each yield curve point is getting impacted. All the points on the yield curve is moving parallel, right? But you could have a scenario wherein the yield curve is like this, and it stays like this, and it moves like this. So only certain points on the yield curve is getting impacted. So this is a structural risk. So only those points which get impacted, and the change in bond value due to change in the duration of those points is known as the key rate duration. Portfolio change in value changes for value change in specific point of yield curve, structural risk. Formula remains the same. Change in portfolio is duration into change in YTM or the PV01 formula. Always remember to read the LOS before you move ahead. Now in this LOS, the last LOS, is asking for construction. LOS is asking for construction. So that is, you have to tell what is to be done. You have to tell what is to be done given a scenario. So let's take a scenario wherein the bullet bond is concentrated 100% in the 7 year, this can be years, 7 years tenure, and the barbell is 50% in 3 year tenor and 50% in 11 year tenor, and ladder is 33.3% in 3 7 11. The duration for all these bonds will be 7. See, for this the duration is 7 because it is in the seventh year bucket. For this it will be again 7% because this is 50% into 3 plus 50% into 11, that is 50% of 14, which is 7. And ladder will be again 33% of 3 plus 33% of 7 plus 33% of 11, that will again come to 7. So for three types of bonds are, if you want to target a duration of 7 for your bond portfolio, you can have a ladder portfolio, you can have a bullet portfolio, you can have a barbell portfolio. Now we have to anticipate what happens when a yield curve steepens. So this is your normal yield curve. This is your normal yield curve. So what happens if the yield curve steepens? Let's take an example. Oh, I'll take the purple color. I like this one. So what happens? It's too steep. Let's remove the steepness. So this is your yield curve. And what happens if the yield curve steepens, right? If the yield curve steepens. When the yield curve is steepening, what is happening? Where is the interest rate risk increasing? Here, because your interest rates are going high, your prices will go low. This, if you see, this is a short term bucket, a medium term bucket, and this is a long term bucket. Which portfolio has the least exposure to the long term bucket? If you compare these three, which portfolio has the least exposure to the long term bucket? It is this bullet portfolio. There is no exposure. So whenever the yield curve is steepening, bullet is best with no exposure. And which is the worst? Which is the worst? Barbell. It has 50%. The ladder has 33%. Barbell has 50%. Barbell is the worst with most exposure. If you have exposure at the end of the yield curve which is increasing, your portfolio value will go down. Let's take another example where the yield curve is steepening. Where the yield curve is steepening. So we have a yield curve. Now the yield curve steepens. Now what is happening? Here the interest rates are going down. Here the interest rates are going up. So bullet is worst with no exposure because bullet is in the middle. It has no exposure, so it is worst. Now barbell is best with most exposure. Again, the opposite reason. Now the long term rates are going down. If the long term rates are going down, your portfolio value will go up because prices go up. Since the prices go up, you need to have exposure into that sector. Which portfolio has the maximum exposure in the long term? It is the barbell portfolio. If you see, all these points are interconnected. Let's see the second point, the third point. The curvature increases. I've denoted this in red color and I've written this in red color. So yellow is the normal yield curve, and red is when the curvature increases. The curvature increases. So assume yellow to be the initial yield curve, red being the curvature increase. Again, you only tell me what is happening over here. When the curvature is increasing, the barbell is best. Why? Because you have exposure in short term and long term. You have exposure in short term and long term, and in the medium term, you are entering into a price loss. So over here, let's consider the scenario that we have taken. So curvature increases, so you have exposure to short and long term. So barbell is best, no exposure in middle term. What is happening in the middle term? The rates are increasing. When the rates increase, the portfolio values goes down. And what is happening to the wings? The wings are going down. So if you have exposure in a falling interest rate market, then your interest rate, your portfolio value will increase. If you go back to your the second chapter of fixed income that I've covered, it looks like a positive butterfly structure. Look at this as a positive butterfly structure. Positive butterfly structure. This term is also known as super bubble. This is known as super bubble, wherein you long the barbell and short the bullet. Long the barbell and short the bullet. When the curvature decreases in green color, you can see this in green color. When the curvature is decreasing, what is happening? Bullet is best with max exposure in middle turners, negative butterfly. Remember this from the original this thing, the negative butterfly. So this was the positive butterfly. This is the negative butterfly. Short term, long term, medium term. Over here, medium term, short term, long term. So when the curvature decreases, when the curvature decreases over here, let us take a different color for this. This is the positive butterfly, long term, short term, medium term. Let's change the color for the negative butterfly. This is already done in chapter 2. I'm just covering it again. Long term, short term, medium term. Okay, so the first one is when the curvature increases. Curvature increases is the blue one. When the curvature is increasing, it's better to be exposed on the short and long term. So this term is known as super barbell, wherein you long the barbell and short the bullet. The second one is curvature decreases. This one, wherein you have the exposure at the yield curve which is falling down. Which yield curve has the exposure? Which strategy has the exposure at the medium term? Bullet. So bullet is best when the curvature is decreasing. What are condor trades? Similar to butterfly trades, but with two positions having closer durations are used for the portfolio, bullet portfolio. So over here in the first strategy, the green one, we are longing the barbell and shorting the bullet. In the second one, we are longing the bullet, shorting the barbell. So over here, condor trades are similar to butterfly trades, but with two positions having closer durations are used for the bullet portfolio. So the bullet portfolio, which is mentioned over here, 100%, might not be 100% 7 duration kind of a thing. So long bullet, short barbell in a condor rather than a 7% being a centralized this one, you might be 50% in 6.5 and 50% in say 8.5. So that brings around 7.5 an average. Okay. So or 6.5 and 7.5, and that might bring a 7 as an average. It's basically using two different tenors rather than a single tenor for the bullet portfolio. Nothing different. So condor name is kept on the bird, the condor bird, which takes similar shapes like butterfly, but the wings are very wide. The condor wings are very wide. So that's a separate topic. It's very important in the derivatives section also, but not in CFA as such. Okay, let's move. So last chapter is intermarket curve strategies, wherein you are involved in two different markets to do your trading. It is based on the manager's view of the different markets currency. So you are borrowing in dollar. You are borrowing in dollar, and you're once you're borrowing in dollar, and you're investing in INR. So the dollar interest rates is low, the INR interest rates is high. So you have an arbitrage over here, but nothing comes for free. So you are exposed to FX risk. If the FX risk moves against your position, if the FX rates move against your position, your carry trade will become a loss. Aims to borrow low, invest in high, and manage currency risk. Pay in domestic currency at lower end of the yield curve and invest in steepened currency in the foreign currency. Similar what we have already discussed in the first slide. And what are the returns? The source of return, income returns, which is the interest rate, rolling down of the yield curve, price changes in the market. Very simple. It's quite self-explanatory. The next chapter is a short one. I can cover it in this one, but uh, okay, let's cover it. Let's cover and get over with fixed income. The next chapter is credit strategies. So credit over here means the riskiness of a bond, the default risk of the issuer who has issued the bond. Risk involves in IG and HY. IG means investment grade. Investment grade means less risky. High yield means risky. Why will someone give you higher yield? Because he is not able to raise money at a lower interest rate in the market. That is why he is giving you higher interest rates so that you give him the money. So high yield are riskier, IG is close to risk free. So what is the credit risk involved? Default risk, loan given default, loss given default, sorry, probability of default. These are some terms which are important for understanding the credit risk. And what is the spread risk? It is a change in price due to increase in yield, the credit spread. If you remember, the change in price is a function of duration and change in YTM. It is function of duration in and change in YTM. Similarly, a change in value due to credit risk will be a change in spread duration. Change in spread duration. That is change in price due to change in credit spread. Are you getting my point? Let's revisit again. When a bond is considered, the formula is change in YTM into the modified duration. This is for the price risk. And if you want to see the credit risk, you just replace this modified duration by spread duration and the change in YTM by change in spread. That's how you get a change in value because of changes in spread. IG is quoted as treasury plus bips. Why? Because treasury is a risk-free rate. So some percentage of credit risk over the treasury risk. So IG is quoted in treasury plus basis points, and usually high yield is term is quoted in price because it's mostly above 100, given that the yield is very high. It's mostly below 100 given that the yield is very high, and it is easier to comprehend. The bond price is below 100 and high yield is generally quoted in price terms. So what are the credit spreads that we know? This we are doing ever since we have started doing CFA, so nothing great over here. Let's cover it simply. G spread, it is basically the spread of the bond over the government bond, that is indicating the corporate risk. I spread is similar to the G spread but uses the swap curve. Why? Because swap curve has more tenor points. It has more flexibility compared to the traditional yield curve. Z spread, it is such a spread which is, if it added to the spot curve, determines the bond's current market value, trial and error basis. Option adjusted spread is the extension of Z spread, useful for portfolio with embedded options. Nothing different. We have done this in L1, L2 n number of times. Then there is a term over here on which there are certain questions which I saw in the practice sums. It is the excess return. So the excess return for a bond is a function of three things: spread, change in spread, and the change in the credit risk, which is probability of default and severity of loss. So change in spread into time minus change in spread minus the spread duration minus the credit risk. So this function, to remember this thing, you can simply break this formula using, see, this is the duration risk, this is the duration risk, this is the credit risk, and this is the return due to the passage of time. This is a return due to passage of time. So duration, time minus duration minus credit risk. When you break it down, these terms will be given to you in the exam. You don't have to find these terms. You might have to interpret it, but you don't have to find it or calculate these terms. But for now, just remember this formula, and the breakdown is credit risk, duration risk, and the passage of time. So your excess return is dependent on the credit risk. Why? We understood that high yield bond is a riskier bond. So higher the credit risk, higher the yield. Because if the credit risk is high, that means the returns should be higher because I should be compensated to take that higher risk. So that's why credit risk is a function of excess return. Okay, bottom and top down strategies. It's very simple. You can just read through the slides, or maybe you can read through the books. I've just tried to, condense this. So in the bottom of what you do, you start up with the bond universe and segregate them as per sector. match the benchmark weights and alter if there is any opportunity. That so in bottom up you start with the bonds, then you maybe you categorize all your municipal bond into one, sovereign bond into one, and so on and so forth. You can use the EXR model, the last model that we saw, the excess return model, which is based on time, duration, and credit risk to identify any excess return. In the top down, start with the macroeconomic factors such as economic growth, GDP, etc. This can be used to overweight and underweight sector based on the expectation. The focus is on the business cycle. Since the view is at macro level, it is better positioned to manage overall interest rate risk. So let us understand this in very, very simple terms. Start with macroeconomic factors can be used to overweight and underweight sectors. Now, suppose if the commodity or the metal cycle is going good, now obviously these companies are high risk companies because they are commodity based company. But if the cycle is just started, the business cycle has just started, so you know that these companies are going to do well. So might as well you invest in these companies' bonds because the default risk goes low. So because of your macroeconomic study, now you know that the oil sector is coming up, the metal sector is coming up, the commodity cycle has just started to go up. So it's better to invest and overweight in these sectors. Also, if you see what does central government do, what does an RBI or a Reserve Bank of India or a Fed does, since they manage the economy, they know the macroeconomy, they are able to gauge what is the pulse of the interest rate, how much interest rate will be just enough to curb the inflation, and how much interest rate will be just enough to trigger the growth without hurting the inflation. Why they are able to do this? Because they are doing a macro level study. They are not going into the micro level, they are doing a macro level as to at the macro level what is the preferred interest rate. So when you do a macro level study, you are in a better position to react to monetary and fiscal policies, right? And you can adjust the portfolio based on that. And you are also informed about these policies, you also take in account these policies, the impact of these policies in your models for predicting the yield curve or projecting your fixed income portfolio and so on and so forth. Last two slides are again very self-explanatory. We'll go through it simply. Liquidity decreases in times of crisis. The bid-ask widens. The fund flow into IG and out of high yield. What happened in 2008 crisis? The bonds which are issued by Lehman Brothers and all these companies which were having a lot of home loans, those bonds were dumped in the market. Those bonds were dumped in the market. Some of the bonds also reached around 120, 130 levels, and the money came into the US Treasury bills. The money came into the US Treasury bills. That is what it is written over here. During times of crisis, the money flows into IG from HY. People dump riskier securities and enter into risk-free security. To manage the liquidity, the manager can invest liquid cash, invest in CDS, and rather hold the vice way. So this is basically in terms of high liquidity environment. So when you have high liquidity, you can park your liquidity into other less riskier instrument other than buying a high yield bond. You can either put it into cash or cash equivalent products like liquid funds, or you can invest in CDS or other structured derivatives which are having a limited risk or a limited downside rather than holding the high yield securities which can act very, very volatile in times of crisis. Tail risk. So, what is tail risk? We have done this n number of times. Let's see, this is your 95% confidence level. So, this is a tail. This is known as CVAR, known as CVAR, conditional VAR or expected shortfall. I've written over there, sorry. So, this is your VAR at 95%, and the area outside that up till 100% is the tail. So, this is the tail risk. Managers can simulate using computer algorithm to manage the tail risk. See what happens is the tail risk is the at the 99% or at the 100%. So that is the maximum risk that the bond can have. And during the times of crisis, after 2008, it is mandatory to report the CVAR of your bond portfolio and also the equity portfolio, and keep provisions for that to provide as collateral. To keep provision for that to provide as collateral. If you have seen the movie The Big Short, this guy, Michael Burry, he went and took on CDS against the investment banks. Why he did this? Basically, he wanted to protect his basically he wanted to exploit this condition where he was expecting a default to happen, and when the default happens, you are paid by the company which is selling you the CDS. And to enter into a CDS, you have to pay a premium like an insurance, right? You pay a premium, and the insurance guy will pay you when you fall ill, or you're hospitalized, or you need something else, or upon death the life insurance is paid. So in that case, uh, the CDS premium is taken by the CDS seller, and that protects your position. The last is the international credit risk. Investing in emerging markets have liquidity, credit, and legal risk, as emerging markets have problems of commodity based economy, government ownership, and unqualified rating mechanism. What is this unqualified rating mechanism? Everything else is explanatory: commodity based economy and government ownership. Unqualified rating mechanism is very famous in India, at least, wherein Reliance group of companies led by Mukesh Ambani actually has a credit rating more than India's sovereign government rating. Actually has a more better credit rating than India's sovereign credit rating. But that cannot happen, right? Because that is demeaning your own country, and it's meaning it is explaining that an entity is bigger than the nation. So that is why it's not exposed that much, and that is why this cannot be qualified. It's an unqualified rating mechanism. These are the problems for emerging markets, where certain companies have good pedigree and they are expected to do better than the sovereign bonds. In emerging markets, the government ownership is very much, even in India you can see the government is involved in almost all industries, right from oil, gas, minerals, metals, PSUs, running banks, running airlines, running shipping corporations, and so on and so forth. So these, because of this thing, the private investments is very low from the external market, because they don't like the government intervention in all the intervention of government regulations in all the in all the industries. Intra exposure may lead to currency and legal risk. Obviously, at any point of time, if you're investing in an emerging market, you're always exposed to a currency risk, because this is the currency which is supplied. So you are always, your investments can get deteriorated. And legal risk, because the government holds a bigger portion of the assets. That is why a government might not honor the international trades obligations, like it's happening in Cane India, right? The Kane company versus India, Vodafone versus India. You can go and read these case studies, that what are the actual risk of investing in emerging markets. Though both these things have been very well solved by the government, hats off. But yeah, these are the part of case studies for you to understand from a finance perspective. And what are the benefits of structured instruments over corporate bonds? So corporate bonds are issued by not so greatly rated companies. They may be double rated companies, but not risk-free companies. So corporate bonds are a little riskier. What are the benefits of structured instrument? They also have higher yield and higher expected return. Tailored risk exposure. Why tailored? What do you mean by tailored? Tailored means custom. Tailored means custom. Now, since the instrument is structured, you can structure the risk as per your risk profile. This I have not covered. This is simply a definition of the products. But in the exam, I saw one of the questions on CDO and CLO. So make sure you know the definitions and the usage of these products. I think so. We are done with fixed income too. I I just hurried on the last part where it's more or less, uh, theoretical. Thank you.